Okay, hello everyone. I'm Hyung from Crescent. Nice to meet you, all of you guys. So in this time, I want to introduce the discussion around the future of on-chain liquidity. So there are different kinds of elements of an exchange. So in history, we have traditional exchanges. With TradFi, we say, we have different kinds of elements, including assets. So we have like stocks, coins in Binance, and also like derivatives traded on traditional exchange. But in decentralized exchange, this is expanded to any kind of form of tokenized assets, even with collateralization, but also like virtual assets. Secondly, for the matching, traditional exchange used to match orders with Orderbook, but we see the innovation coming from decentralized exchange with AMM, which is automated market making, and also employing the historical Orderbook feature, but also it is expanding with other new features with more efficiency and more inclusiveness. Now, also we have liquidity coming from market makers in traditional exchange, but in decentralized exchange, yeah, here. So in decentralized exchange, we have liquidity pools and market makers and other participants who provide liquidity. So there are more democratized and more efficient liquidity provided from wider participants. And traders, in traditional exchange, most of the traders are like traders within this country, clients of this broker firm like investment bank. But in decentralized exchange, there's no permissioned process to participate. It's permissionless from the globe. So if we create a decentralized exchange in one country, then the clients are coming from the globe. And especially without bank accounts, a lot of people, more than billions, does not have bank account, but they can also participate with their phone and internet. And also ownership of the exchange. Traditional exchange owned by government or like a government-owned corporation. But in DEX, we are providing more ownership to users and participants and contributors of the ecosystem. So it is more owned by public, and it becomes more like a public goods than owned by government or corporation. And on the settlement layer, when you trade on traditional exchange, the settlement happens with centralized process with delay. But in decentralized exchange, because it is well verified, so that it can be trustless and immediate. And also information part of view, a traditional exchange provide information with closed network, and the information about the process of execution is unverifiable. But in decentralized exchange, everything is transparent, publicly open, and it is verifiable by anyone. So we see this lot of different characteristic of traditional finance and decentralized exchange, which disrupt the market. So want to share evolution of DEX technology. First of all, we see Orderbook DEX with on-chain settlement, off-chain Orderbook. So in this time, off-chain Orderbook is not transparent nor trustless and centralized operation, so it didn't actually solve the problem. And also, we saw a constant product AMM model, automated market maker, so it is fully on-chain DEX with AMM as liquidity provider. And now we see more expansion of mechanism coming from finance or balancer or different kinds of AMM, providing liquidity with different kinds of algorithm. So it is expanding the innovation of liquidity providing with more capital efficiency. So now we see more order book DEX on layer 2, such as DYDX or Loopring, providing order book DEX with roll-up skills. So still, a part of the order book operation process is centralized, so it is causing regulatory risk and also transparency and trustless of operation problem. So now the recent trend is creating DEX with on-chain order book on app chain. This is because creating DEX on a chain as a smart contract is depend on the infrastructure of the blockchain, layer 1 blockchain. And this order book does need quite a lot of performance demand because if you imagine Ethereum processing less than 1,000 transactions per minute, but still the order book requires more than 1,000 transactions from one market maker actually. So this like cannot be compared to infrastructure with more customized blockchain so that it can compute all the necessary functions in Orderbook. So I want to share topics, 7 topics, how DEX can be evolved in the future. First of all, fully on-chain DEX. So historically, in Ethereum, as I explained, the performance of the blockchain does not allow fully on-chain DEX with Orderbook. So that is why AMM came out. That was the practical solution in Ethereum to provide fully on-chain DEX. So they have to forget about Orderbook. But now, most modern blockchain created like even 5 years ago, the performance is much better than this old blockchain technology, and therefore we don't have such problem anymore. So we are moving on to better efficiency and freedom for decentralized exchange. And also for fairness of trading, the DEX should be fully on-chain, especially for the order book, so that everyone can verify and transparently see the process and confirmed order on order book. So now we are approaching with more app chain with optimized setup. Order book DEX is a very specialized application which demand a lot of performance. In most applications, it doesn't. So Orderbook DEX will be the one of the very rare kind of application which need app chain infrastructure. So I want to introduce more about the comparison between Orderbook and AMM here. So first of all, efficiency. This means capital efficiency. So Orderbook market making is having very high capital efficiency. This is because when you want to provide liquidity within certain range, then you can just place order within like 0.5%. But in basic AMM, you need to provide liquidity from price 0 to infinity. So most of the liquidity is wasting, locating in the price where it will never be reached within a day or even a year. Also, for freedom of providing liquidity, Orderbook AMM can be customized so that market maker can provide liquidity with their own interest. But for the AMM, the liquidity is provided from the algorithm chosen by the AMM DEX. So the freedom is very low in this system. In execution point of view, Orderbook has a more manual function. So you need to like throw the limit order, then you need to modify this order and cancel this order all the time. So there will be lots of transaction on the Orderbook. But in AMM, the liquidity is provided without any transaction. If you lock your capital in there, then the liquidity can be provided automatically. So it is more automated, and it is an advantage of AMM. Also, for the openness of participation, Orderbook market maker is mostly about professional traders with enough technical abilities and financial engineering skills so that they can manage the risk while market making. But AMM provide more open opportunity to individuals so that anyone can provide liquidity from this predefined algorithm. And for the matching, Orderbook is more expensive because there are lots of transactions coming in for providing liquidity, but also trading. But AMM, because liquidity providing does not need any transaction, the matching will be much cheaper in AMM. So if you can see, there are advantages and disadvantages within different mechanisms. So the future is to combine these both so that we can take advantages from these two different mechanisms. AMM with more automated feature, more cheap calculation, and Orderbook, better freedom, better capital efficiency. So AMM liquidity and Orderbook liquidity will compete each other within this hybrid DEX so that it can provide most optimized liquidity for different situations. So this is a hybrid DEX providing liquidity from both mechanisms. So AMM will provide liquidity as a group of limit orders on Orderbook so that Orderbook can match these orders coming from limit orders, but also coming from AMM at the same time. So in this way, liquidity provider within AMM and Orderbook can be compete each other for more efficient liquidity providing. We also have more future on the customizing of AMM. So one topic will be dynamic ranged LP. So ranged LP means that because the basic LP provide liquidity from price 0 to infinity, they don't have any ability to provide liquidity in certain range. But range liquidity provide liquidity with predefined price range so that the liquidity can be amplified within this price because from this same total value locked. Dynamic ranged LP means that for certain token pairs, the relationship with these two tokens is quite packed each other, but with moving price. So dynamic ranged LP can provide liquidity with moving price range so that it can provide liquidity even though price has changed. Also, like curve finance, they provide liquidity with a changed curve from a basic constant product model. So that is one example of expansion of LP curve. But we can imagine more expansion of curve and different liquidity concentration within different price range. So this is a future we can have more innovation with more freedom to provide liquidity. And also there will be LP with more virtual derivative replication. So when you provide liquidity on LP, so you are passively choosing your risk following from the defined algorithm in AMM. But if you want to provide liquidity with your own risk appetite, then why don't you create your own structure for LP? So if you can imagine derivative position such as covered call, then this covered call position can be copied in LP so that you can provide liquidity with your risk related to this kind of derivative position. So one of the biggest topic in DEX is preventing front running, and which is called MEV also. So there are several solutions to this. One will be batched matching. So batched matching means that in every different DEX operating right now, most of the DEX is executing match with sequential order. It means that if there's a transaction coming in with a lot of transaction coming in with order, then it is sequentially executed one by one, so that the sorting of this transaction within a block matters very much. So the time is prioritized within a block with different transactions. So it means that low latency is a big advantage for a trader to utilize their advantages to take more profit. But it is not a new problem. When you see traditional finance with different exchanges in the world, you can see that like financial institutions and hedge funds having technological abilities and financial support to provide better infrastructure. They have better low latency so that they can provide liquidity, but also taking more profit so that ordinary traders will suffer from loss which are taken by these giant institutions. So this is already happened in traditional finance, and it is just the blockchain is mimicking again this problem. But I think the decentralized nature, we can improve this by more fair algorithm of matching, such as batched matching. So batched matching means that the blockchain does not prioritize transactions within a block, so that even though you are a little bit later than other institutions with better low latency, still the transaction will be fairly matched each other, so that you really don't need to be like very competent with low latency, like sub-second, because it doesn't matter at all when you match each other with institutional orders. And also, we can have some very sophisticated social monitoring of blockchain. So the process of matching orders within centralized exchange is not transparent. So there is no way for users to see how it is processed, how it is handled, how it is prioritized. Everything is in black box. But in decentralized blockchain, everything can be seen in the internet with all this transparency nature. So people can develop more analyzing software so that you can see more about the process of transaction broadcasting and prioritization of orders and everything. So this will improve our public power to prevent this front running and unfair execution. And threshold encryption also allows blockchain to encrypt your transaction before confirmation on the blockchain, so that even validators does not know the content of the transaction. before it is confirmed. So in this way, even validators cannot selectively censor or prioritize transaction within a block. Another feature of expansion will be expansion of tradable assets. So in current status in United States stock market, 1/3 of the total volume traded is actually ETF. So like 1/3 of total volume in stock exchanges ETF, and the other 2/3 is native stocks. So, and it is even increasing over time. It happened within recent 10 years, and it is rapidly growing. So what it means to blockchain ecosystem is that currently DEX and even centralized exchange, they have assets traded, 99% native tokens. But there is very rare number of synthetic tokens traded on exchange. But it will be different in near future. We have more investment position in different DeFi products and different tokens, so that users does not want to invest into research in different kinds of tokens or DeFi products, but they want passive investment. So more synthetic tokens will be available in the DEX, and we need to provide efficient liquidity for these synthetic assets. And providing liquidity for these synthetic assets is completely different compared to native token market making. So it is really difficult for even market makers to understand. But this is one of the areas we want to expand. We have also real-world assets such as real estate and stocks and bonds and FX to be traded on DEX. It has some regulatory problems, but eventually we believe that we will see it. And also there are more NFT assets in blockchain, and there will be better systemic approach to provide better liquidity and incentivization rather than just existing solution right now, so that it can be evolved over time. Also, managing LP is really difficult. So unmanaged LP is not attractive in most AMM right now. If you see the Ethereum price chart, when you hold this Ethereum for about 1 year, then you will experience like minus 60% or plus 500%, more than 50% of possibility. So it means that impermanent loss caused by this like 1 year holding period is massive. And statistically, it doesn't approve the position by like 15% APY. So it doesn't make sense for investors. So the risk should be well managed so that the risk can be minimized and the return can be kept. So there should be more LP management service automatically on chain, so that the investment point of view, better Sharpe ratio can be achieved. Also, we need different kinds of trading automation, including TWAP and automated replication trading, stop loss order, but more importantly, it can be all gathered as a generalized programmable trading, so that service can be provided with better automation. So let me introduce our Crescent network roadmap, because all these topics I discussed in this talk is actually our roadmap. So we have Orderbook AMM hybrid, batched matching, range liquidity alive right now. And this year we are going to provide dynamic ranged LP, different synthetic tokens coming from Cosmos and Ethereum, and expanding to different L1s in the future, and managed LP service with hedging and leveraging functionality. Okay, that's all for my speak. So do you have any question? Please raise your hand. No. Then let's wrap up here, and thank you for listening.